All right, we're getting quite some people here. I guess we'll wait another minute and we'll begin. If any of you want a copy for the slides, I'm going to put it in the chat right over here. You can all use the link to download. You can get it. All right. Alrighty, so I'm going to begin here right now, and this webinar is going to be focused on, it's more like the way I prepare this webinar, it's like a year-end checklist of stuff we would do in our bookkeeping company to prepare for year-end. Now, we are primarily focused on inventory businesses. I mean, we focus primarily on e-commerce businesses, which is an inventory-based business. So in this webinar, we're going to be talking a lot about making sure the books are accurate, making sure the books are up to date, what to look out for, and it's going to be tailored for product businesses. And so as well, more specifically, we'll have a lot of other stuff related to e-commerce as well. So as we begin, the first thing is, one of the biggest challenges is how to determine accurate inventory value year end. Now, why is this so important? Just to explain to you that if the inventory is off, so if you have a client that you're dealing with, let's say has $3 million worth of inventory, and you have a discrepancy of, let's say, $300,000, which is a 10% discrepancy, their profit and loss is off now with $300,000. The profit and loss is so these are huge, which would make a big difference. So it could be that, let's say, a company would show $250,000 in profit, but that's based because their inventory value is valued at $3 million. If the inventory is not $3 million and really 2.7, then the company didn't make any money at the end of the year. So that's why it's very important to make sure that the inventory value you have at year end is the correct value, just to understand what the profitability of the business, what the health of the business is, how healthy is the business. And also you want to make sure that, I mean, you could say good and bad, meaning if the company didn't make any money, then it's bad, but on the good side, at least they won't pay taxes. So you want to make sure that, if they didn't make the kind of profit that they didn't make, that gets adjusted on the profit and loss. So that's why it's very important. And that's why you want to make sure that you have the proper inventory balance. Before I begin, I'll give a little introduction about myself. I won't bore you this too long. I graduated FTU with a master's degree in accounting. I've worked as a CFO for a wholesale kitchen company carrying over 25,000 different SKUs. And primarily, a lot of my experience comes from there. A lot of stuff we'll be discussing about the things that I've done at my old job as a CFO and what I do today for other companies as well. But inventory value was one of the biggest challenges. And in every big company, that's the biggest challenge in terms of proper determining the proper inventory value. And I started my first bookkeeping company in 2017, meaning we still run a bookkeeping company today up to date till 2017. And then I also volunteer and teach in the local community. So as I begin, let's give an introduction to inventory valuation. So the first thing is, when you're going to go into your accounting system, whether you're using QuickBooks, QuickBooks Online, QuickBooks Desktop, whether you want to use Sage, SAP, NetSuite, whatever software you're going to be using you're going to have on your balance sheet, you're going to have something called the inventory asset. And the first thing what you want to do is you want to take that inventory asset and you want to get it on an itemized list, and you want to break it down on to a SKU level. That's the first thing what you want to do. And the challenge is always what you want to see is you want to make sure that your itemization of your SKUs match back to your inventory. That would be, and that's always my first step, and that's really how we always do our bookkeeping, and that's something we do all the time. So I'm gonna share my screen a minute, and I'm gonna show you here a couple of samples. So if you see over here, my screen, I have a sample QuickBooks file open, and I'm gonna go to reports. I'm gonna show you in a minute on online, and I'm showing you first in the desktop version. So if we're gonna go to company financial, we're gonna run a balance sheet. What we see over here is inventory assets, $30,000. Now in QuickBooks, what you would want to do is you'd want to go to inventory valuation summary, and you want to have the same number over here representing back to your balance sheet. So if I want to know if this $30,000 is accurate, what I would do is I would pull a detailed report, which if I go back to my valuation summary, this would be my detailed report that I would look at. So I would say, okay, my asset value is down to is 30,000, and I have it broken down per item. So for example, I would afterwards do a physical count. I'd go into the warehouse, say, okay, we're showing that we have 423 cabinet pulls. Do we actually have these on hand? And I would have somebody in the warehouse counting all these items and matching it up, or at least knowing the approximate. But the first step is to get this report, to get this. Now, if you're not using QuickBooks or whatever other software you're using, whatever you're using, you're gonna have on your balance sheet an inventory asset. And whatever you're doing, you want to make sure that you can break this back up per product. And once you have it per product, you want to actually go and do a physical count. Now, if you're like in the eCommerce section or other stuff, you can pull reports on like a 3PL or get reports from Amazon and other stuff. I'll show you a different example over here. So in this example, I'm going to go over here to my balance sheet, and I'm using now QBO. So on my balance sheet, I have something called inventory asset, $73,000. When I'm going to go now back to the report section, what I'm going to want to see is I'm going to type in over here, it's called the same report, inventory valuation summary. And if you see, this is 106. Now, I know why it's like this, because this book is not up to date. But what I'm trying to point out is that the asset, now when I'm going back to my balance sheet, the SKU information is there's a discrepancy. So this is the first thing where you start to see, hey, this doesn't make sense. And if you're dealing with anybody, if you're dealing with an inventory worth of 4 to 5 million, guaranteed, most of the times there's going to be issues. And my team can definitely, they can definitely vouch for this. We have almost every, like sometimes it does match, sometimes it doesn't. And the idea is to go in afterwards and see, how come it's matching? Is it not matching? And what are the issues that are what are the issues that are causing it not to match? And that's what you want to make sure that you get this properly. So that would be the first way. What we would do is determine the asset value, making sure that what we have on the balance sheet is what matches back to our SKU list. So if we're tracking inventory in QuickBooks, we would use this report. If it's QuickBooks Desktop, we'd use the other report that I showed you before. If we're not tracking inventory in QuickBooks, then what we would do is we would go back to the other softwares that we're using, whatever software we're using, whether it's going to be an inventory management software for eCommerce, or whether they don't even if they use spreadsheets, whatever they use, we want to get that SKU list with the average, with the per SKU, the value per SKU, total number to match back what we're reporting on the balance sheet, which is super important. And I can say probably very few bookkeepers do this. It's just because something hard to do. And, you have to get from the client all the information. You have to put everything together. But ultimately, if the inventory is not being reviewed and it's not being done 100% accurately, when it's $4 to $5 million worth of inventory, big chance of a 10% discrepancy, or I would say even 15% discrepancy. And in that case, the books are completely off. So that would be the first step and something we would look at. So if you're going to, so what we want to do is we want to get explanation of the asset value per product. So this is something that we just described. We want to get an asset value sheet. So we want to have every single product, understand how much is this product worth, total valuation of that, then taking that value from the asset product, and we want to match it back to the balance sheet. That's what we want to get. Now, if you're going to be using, if you're using QuickBooks, this is what I showed you before. You want to use the inventory valuation summary report that's available on QuickBooks Desktop and that's available on QuickBooks Online. And as I showed you before, my desktop actually matched back to the balance sheet and my QuickBooks Online didn't. And that's exactly where I would dig further in to understand the discrepancies between the inventory asset account and the inventory valuation summary and making sure those two stuff align. And then the other thing is what you want to do as well is reconcile the on-hand quantities with the physical quantities. That's what we want to do. So if you're dealing with an e-commerce business, which we do a lot, is the first thing is if you have inventory in Amazon. So currently, from what I know, there is few places where inventory, I would say 3 places where inventory can be dealing with the e-commerce. Actually, let's go to 4. So if you're dealing with Amazon, Amazon has something called FBA, which means fulfillment by Amazon. So there will be inventory laying at Amazon. So you would want to get from Amazon called something, a ledger report. Now there is softwares available, like for example, software like ConnectBooks will provide you all this information. But if you're not using a software or you don't have any other software properly in place, or you want to get it directly from Amazon, then you would log into Amazon, you go to the report section under fulfillment, and you would find something called an inventory ledger. And you would put in the dates that you want. So the inventory ledger would tell you, okay, in Amazon, we currently, let's say, have 100 units left. And then you would need to understand how much the value of that 100 units is. And then that would, you would take the quantities times the value, would give you total value per product. Now, if you're doing Walmart, Walmart has something called WFS, Walmart Fulfillment Services, which Walmart also has their own inventory. So besides Amazon and Walmart, most other places don't really store inventory. Like if you're selling on TikTok, Target Plus, Shopify, Zawilli, Etsy, most of these places don't have their own fulfillment center, meaning a fulfillment center is where you store the inventory and they ship it out on your behalf. Usually at that point, either people will take it from a 3PL. A 3PL means a third-party fulfillment center, which would be like somebody who would do inventory for a lot of people, and they would, have a warehouse and you just, pay for what you keep there. And in that case, what you want to do is you want to reach out to the 3PL and you want to say, can you give me a report year end? Most of the times they should have a login and a portal, which you should be able to log into the portal and review the inventory quantities. So you're going to be pulling quantities from Amazon if you have, and meaning for FBA, you're going to be pulling quantities from Walmart if they're using the Walmart fulfillment services. And then the third place would be using the 3PLs. Now, sometimes they might also have a local warehouse, their own warehouse, which most of the times, if it's a smaller company, it's probably a mess. But you would try to see if they have some sort of software that they use to track the inventory in the local warehouse, or not. You would tell them, can you provide us with the inventory count at your local warehouse? So we take the local warehouse, we take what's by Amazon, we take what's by Walmart, put these 3 numbers together, and that would determine our inventory. The biggest challenge with this is number 2 on my sheet, is in transit. So what happens is when you ship a lot of inventory to Amazon, one of the things you want to make sure is Amazon doesn't have a proper report what's in transit, which makes it very confusing. So for example, if I take 1,000 units of my inventory and I ship it to Amazon, so let's say Amazon only received 500 and another 500 could take them another 2 weeks to receive it. So when I pull my ledger report, what's going to be available in the ledger report is going to be what's actually in Amazon's warehouse. So let's say in Amazon's warehouse is now, they tell me these like 10,000 units. Now from the 1,000 that I shipped out, that already includes 500. So I need to know, okay, so the other 500, you need to include in transit. Currently, there's no good options. ConnectBooks is working on some sort of option for this. We are working on solving this challenge because we have been struggling with it pretty hard. And what I would say is at the moment, what I do now is I try to look through the shipments, meaning I would log into Amazon, take all the incoming shipments and try to see how much is left in transit and then what was actually received it was actually received in the warehouses. Now there is different, we actually do have a certain report that would give you the inbound. It depends how detailed and how you want to go down to the last product, but we do have a certain report that would give you an approximate inbound plus what's in Amazon. But if you want to go to Amazon directly, you would need to pull the ledger report and plus review all the shipments to get that. So you want to put together is what's in the local warehouse, 3PL, what's in transit to Amazon, and then you also want to see what's in FBA. And you want to put together these numbers, and that will give you the actual inventory. This is super important to do. This is crucial because the whole P&L really relies on this. Now, the other thing, what you would also want to do is look over your recent bills from year end. So we have had this many times where, let's say, a vendor would invoice us December 25th, and we would enter the bill, let's say in QuickBooks, December 25th, but the inventory would not arrive, let's say, to Amazon as of till January 2nd. So when we're pulling our inventory ledger report, that inventory is not on Amazon, but it's already on our books because we entered the bill as of December 25th. Now, ideally, the real way to do it is to make sure that the day of the bill should be the day of the receiving. In QuickBooks, it's a little complicated because the receiving date is the bill date, meaning the day of the bill is the day you actually receive the inventory. Like in like softwares like NetSuite, you probably have two functionality. You have a function of receiving inventory, which that can be any single day, and then you would have the bill date, and you'd use like a clearing account to offset it. But what you want to make sure is that inventory was shipped out year end and did not get into your possession till in the next year, which would be 2024. You want to make sure that that inventory is not included in your inventory account, because otherwise, basically, you're going to say, oh, these 25,000 units I don't have in hand, let me expense it and write it off, and it's just going to mess up your numbers. So you want to make sure that all those, you take those bills and just move them to next year or keep track of it separately as well. So that would be the basic process, what we would do in terms of, reconciling and understanding the proper, what's in transit and getting the whole thing done. There is a different option, which is a little bit more complicated, is setting up multiple warehouses in QuickBooks and, tracking the inventory per warehouse. The confusing part is always the in transit, what's in transit. And the reason why it's so confusing is because Amazon itself doesn't give you the proper reporting available what's in transit as of that point. All right, so then the next thing is moving on. So the next thing is what we want to make sure is recording sales and invoicing. So one of the things is we want to make sure that, what's the proper method of how we're going to record sales, and then how to handle marketplace orders and payouts. So handling marketplaces per sale. So one of the things you also want to make sure for year end is that you want to make sure that you recorded all the sales that happened in 23 in 23. So for example, the way marketplaces work, and that would be specific for Amazon, eBay, Walmart, Shopify, Get to Soon, is that they do like something called a payout, which they accept the money from the customers, they process everything, and then they will give you the money, like once every 2 weeks, they would give you the money. And in that case, what you want to do is you want to make sure that, let's say you have a payout that would go from December 20th up to January 5th. You want to make sure that the portion that belongs to December is recorded in December properly. Because otherwise, first of all, your numbers won't match back your 1099 that Amazon gives you. And you also want to make sure you have the proper numbers. So sometimes people overlap months, which if you look at the profit and loss on a yearly basis, it's okay. It doesn't matter if it overlaps one month to the other. I mean, if you look at a monthly basis, it won't be a problem. But if you look at it on a yearly basis, as you're closing up year end, you want to make sure that all the sales that need to be recorded in 23 are recorded properly. Now, the easiest way to do it is, one of the easiest way is you can use a software like ConnectBooks or any other product, or I can tell you what to do. You can download the settlement report from Amazon. So what I'm saying specific is Amazon, eBay, and Walmart give you something called like a payout report. You download that report and you look how much sales were for the year of 23, and you make sure those sales are properly recorded as of 23, and you do a journal entry towards accounts receivable. And then for 24, you'll actually record the rest of the sales and then do a payment, which would pay off the sales from 23. So you want to make sure that you take care of including the sales for 23 in the proper year. Before we jump to that, so and then in terms of Shopify, so Shopify and eBay are easier to do than Amazon and Walmart. The reason is that one thing you want to make sure is that certain marketplaces have something called like a daily payout. Shopify will pay out every single day. So for example, the sales that happen today, you'll get paid tomorrow, versus Amazon and Walmart like to hold your money for like 2 months or 2 weeks. And they have something called reserve funds, which they like claw back money. Besides that, they will hold it for 2 weeks. They sometimes can hold additional funds as well, which in that case, you still need to record the sales and you still need to record the income. You just record a receivable that Amazon owes you that money. So what you want to do is with Amazon and Walmart, it's a little bit more trickier. With eBay and Shopify, it's very simple. eBay gives you daily payouts. Shopify gives you daily payouts as well. And besides that, any other marketplace that you will bump into, what you first thing you want to check in terms of year end is how often do they pay out? If they pay out once every 2 weeks, then you have to take the payout report and then kind of break it up between this year and last year. If it's going to be something that they do daily, it should be way easier because it's based on the day. Now, one of the other things we also look into is on the balance sheet. So one of the things we look into making sure, which I see a lot of people miss, is interest on Amazon loans. So when Amazon actually lends you money, what Amazon would do is, let's say they lend you, let's say, $500,000. When they claw back, they will take it off your disbursement report. They will claw back the full amount. What you want to make sure is that you recorded the interest on your Amazon loans. So the way you would do that is you log into the Amazon account, you would find the loan, and you would pull off all the information, meaning you would pull off the interest section on the loan and make sure that that's properly being recorded. You would just debit, interest expense, credit the loan account, and that's how you would record the interest. You want to make sure you're doing that. The other thing you also want to make sure is the EIDL loans. These are the loans that were given out through COVID. What happened was the government said for the first 30 months, you don't have to pay back these loans. So for the first 30 months, it was a pause on all these loans. What happened in that 30 months? There was no payments, but you still accrued interest. So far, what I would say for 2023, all the payments that clients made to the EIDL loan should be recorded as interest only. There was no principal reductions in 2023. And the reason why there's no interest reductions is because for 30 months, you weren't paying anything. So basically, let's say somebody got $500,000 as a loan, and then they didn't pay for 30 months. So they accrued, let's say, another $25,000, $30,000 in interest. So what they're doing now is all the payments are going towards the interest, not towards your principal. So the balance should be the same. Your EIDL loan should be the same. All the interest, all the payments should be towards interest. You can double check this in the SBA portal. You can log in the portal and see, but what I have seen, they're interest only. And the other thing is what we're talking about is ensuring the accuracy of recording withholding funds. So what happens is a lot of times, for example, companies like Amazon or Walmart withhold money. So what happens is they will pay the cost. You will get like a payout, but even in the payout, let's say the payout should have been 600,000, but they'll only give you 200,000, and they will withhold $400,000. You want to make sure that that's being recorded properly. And you want to make sure that's being recorded as a receivable. And when you get that money, you want to make sure you're paying back the receivable and you're recording that as well. So you want to make sure you're getting this picture in the right way in terms of making sure year end, you have everything in there the proper way. Now, this is something interesting that I see a lot of times is, first of all, also verifying cost of goods sold. So really, if you reconcile the balance sheet, meaning if you reconcile the inventory asset, technically your cost of goods sold should be accurate as well, right? Because it's kind of, they kind of like go hand in hand, cost of goods sold with inventory. If cost of goods sold is off, usually inventory is off, and vice versa. But I always like to do it as a double check. And I also like to verify cost of goods sold. So the way I would verify cost of goods sold is we would have like a report, like if we would be using QuickBooks, let's say it depends really what type of business is. If it's going to be like an e-commerce business, we would use ConnectBooks, our reporting tool, which would give us the sales and the cost of goods sold per product. And it would also give us our profit margin. So we would be able to look over the cost of goods sold. We'll be able to see if there's a product that's, let's say, 100% profit margin, that's a red flag. If there's a product that, that's only 5% profit margin, is a red flag as well. Now, sometimes it could be true, or sometimes it could be a mistake. So, those would be like the red flags. Like we would try to want to know, what is your average profit margin? Like an average, are you doing 30, 40% profit? And then we want to get a detailed report matching that back to it. So let's say, for example, if somebody does a lot of wholesale orders, in QuickBooks, you could run something called a sales by item summary report, which on the sales by item summary report, you would be able to go through, and that would give you the sales section with the cost of goods sold section, and that will tell you what the profit margin is, and you'd want to just verify that the numbers are in line. Another thing what you would want to do is going over your accounts payable. So one of the things I've seen that people doing, people like, sometimes you just, what happens is when you have like a good checklist in place, sometimes you're so busy, like you're so into doing your bookkeeping and you're like, yeah, I'm just doing everything. And then at the end of the month, you're like trying to pull yourself together and you want to make sure you really did everything the right way and nothing falls through the cracks. That's where the challenge comes in a lot of times I see. So let's say, for example, accounts payable, let's say you get a bill from a vendor, or let's say, for example, you have a payment to a vendor, but you haven't entered the bill. So what you do is you just put it towards that vendor, and when you get the bill, you enter the bill and then apply the payment. So you could have sometimes negative accounts payable, which is something you also want to review. You want to also, let's say, reach out to the vendors and say, can you give me a statement of how much money we owe you? You want to match it back to the QuickBooks to make sure those stuff match up. So one of the other things you want to do is you want to review your accounts payable and making sure if any missed bills, or making sure the AP aging, making sure there's also no vendors they owe more than 90 days, which usually doesn't make sense. I'm not gonna say that it can't happen, but it's not something that, is a typical way of doing business. The other thing you also want to make sure is that you have no negative accounts payable, and then all the bills were properly entered and stuff will probably come for the same place. Now, it does go back to say that if the inventory is accurate, very unlikely that you should bump into these two issues. But, sometimes I check all of these, and usually sometimes I'll check right away, starting off with the cost of goods sold. Like we want to make sure cost of goods sold is in line. We want to make sure the accounts payable is in line. And then, you want to come back to the inventory and you want to make sure other stuff as well. And then the other thing we'll also want to analyze is payroll liabilities. So payroll liabilities are actually interesting because, and sometimes people like, let's say, for example, we always use a payroll company. We don't do payroll in-house. If it's QuickBooks Online, we'll use the QuickBooks Online payroll. Like we'll use them, or we use, sometimes if we need more robust features, we use different companies for payroll. But one of the things we want to explain is that most of the times the payroll companies will deduct the taxes right away. So let's say, for example, your payroll is $10,000, and let's say the employees get, let's say, 8,000. So there's 2,000 withholdings, and then there's also the employer tax. So let's say the tax portion is 3,000. And the wages is 8,000, so total of 11,000. When you process payroll, what's going to happen is the payroll company right away pulls the taxes out of your account right away. So your payroll, and sometimes it could take a day or two till they get it. So let's say you run your payroll on Monday, maybe they'll pull it out Tuesday or Wednesday. So your payroll liability should really be zero. Most of the times that should be the case. Actually, with QuickBooks, it's a little bit different. I think QuickBooks does not pull out the inventory the payroll liabilities right away. QuickBooks usually, meaning most of, let's say I know like a company like I did with FingerCheck, they'll right away let's say the direct deposit they'll pull out right away, and the taxes will pull out right away, and they put it in their bank account, and then they pay it accordingly. Versus QuickBooks will take the money directly from your account and send it to the IRS, but they do it pretty frequently. So you want to make sure that your payroll liability is not just increasing to out of whack, and you want to make sure it's properly set up. One of the things I see people usually don't set up is paid family leave and disability. Usually there's a certain deduction they allow to withhold from employees, which is, it's a minimal amount, but you want to make sure that it's really not a payroll liability. It's really like, it should be a deduction towards like insurance expense or the paid family, when the employer pays out the bill. So you want to make sure the payroll liability is up to date. It's usually minor, but you want to make sure also it's not growing like crazy. The other thing you also want to look over is the P&L. So one thing I also like to do is I like to do a profit and loss, but you can do the columns by month. So for example, you want to see if there's any trends that are going up. So whenever you run a report, whether you're running it in desktop, you should have the option to do in the tab called show columns by month. Whether you're using QuickBooks Online, you should have the same option as well. And I think almost in every other accounting software that I've worked with, I've seen this option as well. One of the things I always like to do is I like to look by month on the P&L. What I like to do is I like to take, let's say, December numbers, match it back to November. Now, December is holiday season, so you will see different numbers in December than November, but on overall trends, you want to make sure that the numbers, nothing goes out of whack. Like, for example, I don't want to see in 1 month a $20,000 travel expense if that's not what we see every single month. If every month we have, let's say, travel expense around $1,000, all of a sudden $20,000, then I would just verify it. Doesn't make sense that you had these transactions. And it's just, making sure for the accuracy and making sure that the numbers are put in the proper way. And you want to, in general, you would want to look into another site. Now, as one of the things as we has promised on this for this webinar, is that we will be sharing our checklist. So I went to a lot of stuff we look out for. We have more stuff that we would look into, and we have a detailed checklist that we will be sharing to everybody who's joining our webinar. And what I do want to say is that on the checklist, what we're going to be doing is we're going to be having what we'll be doing is I'll be doing videos on the checklist. So what I'm going to be doing is I'm going to be creating Loom videos, and the videos will be linked on the checklist. Like, for example, for better explanation, something, they will be on the checklist, and on the checklist, you'll be able to see, what all the stuff we look into, and then there will be explanations by video for each thing, how to do it, what to do it, and do that as well. Now, we do have a LinkedIn group, where we're going to be posting the checklist will be in the LinkedIn group. So on the slides, or we can put the LinkedIn group I'll put it in the chat over here to join our LinkedIn group. And if you join our LinkedIn group, you'll find the checklist there. And then the additional videos will be on the checklist, and we post additional videos in our LinkedIn group. The other thing is, if anybody has questions directly for me, stuff that you want to ask or stuff that are not clearly explained, I'll be more than happy to answer. But I pretty much hang out in the LinkedIn group. So if you post any questions there, I will be there to respond, and I can answer accordingly, and that's how everybody gets to see it. I'll share a link for the LinkedIn group in the chat. And as we go, we're going to be moving on now to our Q&A session. Yeah, if somebody doesn't have any LinkedIn, we will email the checklist out. But in terms of asking questions, the questions should really go on the LinkedIn, meaning if anybody has a question, the place where I would respond would be on the group. Right. Somebody wants to know if we do one-on-one support. So the answer is the support that bookkeepers want, we offer that all in the LinkedIn group. So all the support that we're going to be giving is going to be in the group. So if you join the LinkedIn group, you will be having everything over there, and that's where you can ask any questions. So somebody asked a question here. I think the biggest issue with reconciling inventories and marketplaces are behind with deposits, meaning QuickBooks' inventory always off. So the solution that we have in terms of reconciling the inventory is, number one, with ConnectBooks, the inventory, even if we bring in the data after you get paid. So for example, if the disbursement starts on December 20th and finishes January 5th, we will record the sales from December in the December month, meaning we will split the December transaction, meaning we'll take from whatever got deposits need to come in December, we will record it in December. Now, the only challenge that I would have is the in transit. Now, we are working on certain functionalities. There is an upcoming feature if you want to use the QuickBooks Advanced feature. This is only available on desktop for multiple warehouses. In that case, we would set up like 3 warehouses, a local, an in transit, and an FBA. And then you reconcile each one individually. So every time you make a shipment, it will go out of local into in transit. And then when it gets into FBA, you would go from there and make sure when it gets into FBA, you would reconcile what's in FBA. So that would be the best way to do it. We're also gonna have additional functionalities on. We will be having additional functionalities on ConnectBooks, which would be able to give you better insights on what's in transit. So if we have better insights what's in transit, that will make it easier to reconcile the in transit and the Amazon together. But on the Amazon side, if you pull the inventory ledger, that should, if you can figure out what part is in transit and have that part, you would be able to reconcile it accordingly. Okay, so Sarah's other question is, what is the best way to make sure the books are accurate? So what we covered in the webinar was mainly more related to like inventory, and we covered like some basic stuff which I see often happening every single month. Like, for example, making sure you're recording interest, making sure to record when certain sales are being withheld. What I would say, the other thing is to look out is, number one, making sure the balance sheet is up to date. That's probably the most important part. What I would say is if the P&L, if something is miscategorized in the P&L, that's a problem, but at least the expense is there. On the balance sheet, which a lot of people like, a lot of times business owners, when you hand them reports, they only look at the P&L, they don't look at the balance sheet. In a certain sense, if the balance sheet is 100% accurate, then that would tell you that the books are accurate. So what I would do is I would go through all the accounts on the balance sheets and making sure those are properly being reconciled. So for example, if let's say a bank account, I want to make sure bank account is up to date. I would make sure the bank account is reconciled, but I would also make sure how many outstanding checks there are in the bank account that have not cleared. For example, if I see a check from 2 months ago that has not cleared, usually that doesn't make sense. I would look into that. So one of the things you want to make sure is the bank accounts, credit cards are up to date. And after you finish reconciling, you want to see what didn't clear. Does it make sense or doesn't it make sense? The other thing you also want to do is let's say, and then every other account of the balance sheet, you should be able to also pull reports in QuickBooks. Like for example, if the accounts receivable, you have accounts receivable on the balance sheet, you want to pull also, like you can pull an AR aging. You pull accounts receivable aging, which that number, the same way as I showed you to run inventory valuation to match back to the inventory asset, you also want to run an accounts receivable report, which that would match back to the accounts receivable on the balance sheet, and same as with accounts payable, and then with the inventory. So you want to basically work your way through the balance sheet every single month to make sure stuff are updated. That will tell you if it's in the right way. Okay, then there's another question is, how do you know if Amazon reserve funds are accurate? So if you want to know if Amazon reserve funds are accurate, well, the first thing is you want to make sure that they ends up coming back to zero. So a lot of times what happens with Amazon is that Amazon withholds a lot of money. And when you click into, if you have a separate account where you record the receivables from Amazon, but you want to make sure that that account gets reconciled as well. So for example, if Amazon withholds you $500,000 on the payout, what happens is the next payout, they'll give you back $500,000 and then they'll have a new withholding amount. So it's similar to payroll liabilities. Most of these stuff you want to make sure at some point in time come to zero, and you want to make sure they come in and they go into the right direction. All right. Does anybody else have any other questions? I'll wait another minute or two, see what everybody else has. The webinar was recorded and there will be a replay. It will be uploaded to YouTube later today. There's one more question. Okay, how am I supposed to check the balance sheet? It's actually a very good question. So a lot of people don't really check the balance sheet every month. They usually like try to just finish the profit and loss and just send that out. What I would do is we try to check the balance sheet every single month, and making sure the balance sheet is accurate is the most important part. One of the things I also like to do a lot on the balance sheet, and that can also have a lot to do with inventory, is we like to check the increases and decreases. So what we want to do is, let's say, for example, what I would tell a customer is, let's say, there's actually a story we have with a certain customer. The customer actually reported at the end of the year $1.5 million in profit, but in their bank account, there's actually no money left. So the question is, if they made so much money, where was all the money? So that this goes really more into cash flow and how to deal with the statement of cash flows. But one of the things you could do is on a balance sheet is you do something called a balance sheet comparison. So what I always like to do is, let's say, for example, I'll be running a balance sheet as of October 31st. I'd want to compare it to year end of last year. Now, what that's going and that will give you the changes. So let's say, for example, as of year end, let's say 2022, we had, let's say, $5 million worth of inventory. Now, throughout the year, they purchased, let's say, another 5 million. So the question is, what is the balance now? So if their balance as of October 31st would be again 5 million, that would mean to say is that they bought additional 5 million in inventory and they sold 5 million in inventory. Well, what I would want to so in the actual case, what we had is this client actually had $5 million worth of inventory year end, and then they purchased more inventory than they sold. So what happened was, let's say, for example, they had 5 million as of December 31st, and then they purchased, let's say, another 10 million. And then they only, from that 10 million, they only, let's say, sold 8 million. So what ended up happening was, in QuickBooks, you'll see their inventory value, the difference would be, the inventory value difference would be 2 million. Because if they had a year end 5 million, they bought additional 10 and only sold 8, that means that they increased their inventory to 2 million. Now, this is not something you'll see on the profit and loss. This is something you only see on the balance sheet. So what happened basically was a customer increased inventory with additional $1.5 million, but the whole, meaning, sorry, they have profit of $1.5 million and they increased inventory worth of 2 million. That means to say all their profit they made, they buried into their inventory. So they actually really didn't make any money. I mean, you could say they did, you could say they didn't, but that's usually something that I always look at is we try to take the balance sheet and compare it to the last year end, and then we want to make the changes. We want to see how the changes fluctuate, and then how does that affect? So in this case, you want to also make sure that inventory is not going drastically up. Now, I probably will do this we're going to be hosting more webinars, and probably the next webinar we'll be talking about is what would be like a healthy inventory ratio, which one of the things we want to see is a healthy inventory ratio would be, the best example I like to use is a grocery. So like if you go into grocery, there's something called shelf space. So grocery has to pay rent. And if it's like in a high demand area, they're paying even more rent. So every product that's on the shelf, there's a certain amount of rent that goes for that product. So the real question is, how much money does that product make to compare to the rent they're paying? Now, the way you calculate it is you want to see how many times a product turns over in 1 year, and based on the profit it brings in. But if a product turns over a lot and it makes a lot more money, then you want to give it more shelf space and you want to give it more space. So really it's something called we call an inventory turnover ratio, which how often inventory turns over. And once you figure out that ratio, that would be able to tell you if this is unhealthy, if this is unhealthy margin and this is something healthy that you want to see. But the main thing what I would say on the balance sheet is I always do the comparison, and we always look what the difference is and what the changes are. All right. Does anybody else have any other questions? Otherwise, we're just getting ready to wrap up. All right. Doesn't seem like we're having any other questions. So if you have not joined our LinkedIn group, go now and join our LinkedIn group, and we will be posting there more tips and any other questions you have about bookkeeping.